How are we getting on, everybody? Hope everyone is well. Today, I wanted to share something quite special here on the YouTube. So for a lot of you guys, you will already know, we've been running the Forex development program now for quite a few months. And every single week, I will conduct a live session exclusive to all of the members in there. And in this session that I did the past week, we were in there for about 3-4 hours. However, for the first hour of it, we went really in depth into Wyckoff, because I know that a lot of the guys in the program have been struggling quite a bit in understanding how to integrate Wyckoff and his theories into the strategy. So we spent an entire hour going in depth into how to use Wyckoff in the strategy. Now, I know for a lot of you guys, you probably experienced this in the market where you're looking for moves, you're waiting for the market, and it feels like every time the market blows up, you've missed the entry. You've probably felt this before, where you look at a market, it's blown up, it's risen very, very quickly, and there's been a lot of momentum, but you're like, damn, I'm too late. I've missed the move. And then you try and get in, and you try and get in, or you start getting a bit kind of FOMO'd because you're like, damn, I want to profit from it, and you start making silly decisions. Now, a lot of what I go through in this video is talking about how can we identify structure using Wyckoff, which allows us to identify when momentum's about to come into the market and allow us to be involved in trades as the market blows up or just before it blows up, so that we can profit from those big, vast, high momentum moves, and also refine our win rate so that we're trading in the right phases of the market. So if you're somebody that has struggled to fully understand Wyckoff or how to integrate it into your strategy, and you're somebody that wants to be able to be involved in those big moves, enjoy this video, and I'm sure it will give you a lot of help in building a more profitable strategy. Hope you guys enjoy. At the start, actually, I want to cover a little bit of a topic that I think will be quite useful to you guys and quite crucial in the way that we understand the markets to be able to profit from them. Okay, so something that I've been discussing quite a lot with the clients is a little bit more in depth on Wyckoff. Okay, and obviously, if we wrap it back to kind of the start of what is the Wyckoff theory. So the Wyckoff theory comes from a guy called Richard Wyckoff, who essentially was a stock trader who was born in the late 1800s, and in the early 1900s became pretty big in the game. And he created his own theory in the markets, because from his time not only trading himself, but he also worked as a kind of a runner, a floor runner in a New York brokerage firm, which essentially just means that back in the day, before the internet was a big thing, when you executed a trade, you had to write down on a piece of paper the trade that you wanted to place, and one of the floor runners would take your piece of paper, run it over to the to kind of like the head broker guy, who would then execute your position to be able to buy and sell into the markets, which is crazy to think now, right? To execute a position, you have to write it down.
How long did that take to actually execute?
I have no idea, to be honest. Let's search that up. How long did it used to take to execute stock position?
I think it went through the phases of 3 to 4 people before it could actually execute. So there can be a delay of between 1 to 5 minutes between each trade that was to be placed.
So what it says, AI overview. Executing a stock position with a floor runner could take from minutes to less than a minute, depending on the distance to the trading post, traffic, and the speed of the runner, as they hand carried orders and ran across the trading floor to reach the correct desk for execution. The overall time was a function of walking and running speeds, with an emphasis of getting to the right place. Oh, getting to the right place to place an order quickly. That's crazy. That's how it used to.
Like designated lanes.
Yeah.
That's crazy.
That is a bit of a throwback. actually. Bit of a throwback. So that's how it used to work. And Richard Wyckoff was one of those guys that would take your piece of paper. I think he was like 15 years old. So it's like one of his first jobs. And he would go and he would grab a little piece of paper and run that over to the correct desk. And what that essentially meant is from like extremely young, so from the age of, I guess, 15, he was constantly exposed to traders. He was constantly around some of the biggest stock traders in the world in this firm that he worked in New York. And essentially, as he came through the game and he spent time with them, getting to know them, he started to get more and more interested. He then started to ask a lot of questions. And I think when he was 18, 19, he started to trade himself. But then he also created an article in the New York Times where he interviewed traders just to get a better insight into like how are they successful, what do they do, and essentially I think a collection of kind of 30 plus years of data and knowledge that Wyckoff, I guess, attained from all of this. That's when he made his theory. And the theory essentially states, and it's kind of based around the composite man theory, this idea that we should view everything that happens in the market as if it's happening because of one man's moves. So almost as if there is a higher power controlling the markets that dictates where the market goes, when does it go there, and why does it go there. And he says, let us call this the composite man. Okay, so the composite man is the person that controls the markets. And a lot of what he says is, to be a good trader, and this is me inferring quite a lot here, but to be a good trader, you have to be able to read and understand what the composite man is planning to do so that you can be on the same side as the composite man. Because if you're on the opposite side of the composite man, that's how you lose. However, what makes that really difficult is the composite man will do whatever it can to mislead you, to give you false sense of direction so that you do accidentally take the opposite side of what they're wanting to do. Does that make sense?
Yeah.
Yeah. So then he came to these ideas that there's essentially two things that happen in the market. There's only two things that can happen. You either have a trending market or you have consolidation. That's it. And he would class this as phase one and phase two. Consolidation is a phase one, trends are a phase two. Okay. So then comes the idea that why do we consolidate? The reason we consolidate, the reason that the composite man forces the market to consolidate is because he is doing two things. He's bringing the market to a consolidation phase, because he needs to gain more force and fuel to make the move happen that he wants to make happen. Okay. In the same way that if you're in a car, you can't constantly drive that car. You have to have pit stops. You have to refuel. It's the same thing with the markets. The markets can't just forever run in one direction. They need to gain fuel. So these consolidation periods are essentially where the composite man is gaining the fuel required to make the next move happen. Okay. However, what happens during these periods of consolidation is because the composite man wants to mislead the public to the best of his ability, all he's going to do during consolidation is give as many false signs and false signals as possible to make you believe something's happening before it does. And this is why we have this idea of market manipulations. It's why we have this idea of fake outs, where the market pretends to break out to one side, or it pretends to break structure to one side of the market, but then reverses and does the opposite. We've obviously been seeing that quite a lot on gold recently. where it's been within a range of consolidation, constantly breaking structure to the upside, to the downside. And it's really confusing. That's because the composite man has brought us to a pit stop in gold and is trying to mislead you by causing breaks of structure on either side. Because when you see a break of structure, what are you likely going to do?
I could get this wrong, but would that be planning your entry?
Perfect. Yeah, perfect. The second we see that break of structure, pardon me, we're looking for an entry. So when we're in consolidation and we see price break out of that to the upside, we're like, cool, let's enter buy positions. And then it comes back down. And then we break structure to the downside. We're like, cool, let's execute sell positions. And then it comes back up. And that's typically what's happening during these periods of consolidation, is because the composite man needs to refuel for the next move, he wants to try and remove as much liquidity in the market as possible. Because for anyone who has active positions, they are taking up some of the available liquidity in the market. Okay, the markets have kind of like a market cap, right? Where there is only so much liquidity in the market at one given point. And obviously the composite man wants to own as much of that liquidity as possible before the move happens so that they can benefit, right? So what they try and do is they try to remove as many people from the market as possible before they make the move happen, because the more liquidity they free up, the more liquidity that they can use themselves to profit from the position. What's actually really, really important with the Wyckoff theory is understanding, well, when is then the best time to get involved in positions? Well, we know then the best time to get involved in positions is once we genuinely have come out of that consolidation period, that phase one, and we've entered the trend, which is a phase two, whether that's an uptrend or a downtrend. We want to be involved in the trend. We never want to trade a consolidating market. We want to trade a trending market. So I have something that I drew out on a whiteboard the other day for Liam, just to help him understand this, where there is 4 different consolidations that you'll see in the market. And the consolidations is essentially what Wyckoff called schematics. He called them his Wyckoff schematics. And there's 4 of them. Because the only thing that can ever happen in the market is you have an uptrend, the uptrend stops to consolidate, and then we continue the uptrend again. That's a reaccumulation. Second thing is we have an uptrend, consolidation, and then a downtrend. That's a distribution. The third thing is we have a downtrend, consolidation, downtrend. That is a redistribution. And fourth is the downtrend, consolidation, uptrend, which is an accumulation. Now, the reason why they're named these things is because obviously Wyckoff made this theory on the stock market. And it's the idea that in an accumulation, once that stock has been oversold, okay, so that stock is very weak, we will consolidate so that the composite man can accumulate as many shares as possible in that stock, so that when he allows this move to happen, he has as many shares in his hand as possible to profit from the increase in price. A reaccumulation is you've moved up, you consolidate, and you're reaccumulating more shares, because by reaccumulating more shares, you're introducing demands to allow the next move up to happen. Okay. Distribution, once we have accumulated and we have reached an overbought point in the market, we will consolidate to distribute the shares back off. So that's where the composite man will then sell his shares back to the market. He's distributing all of those shares back out. Same again in number 3, where we'll move down. We'll realize that we've not quite got enough force to keep going lower at the same pace. So we consolidate, we redistribute more shares back out. which in Forex terms would be we execute more sell positions to introduce enough supply to then make the next move down happen. Then he kind of puts this into an idea of like Wyckoff price cycles, where he kind of states that whatever's happening in the market at any given point, and just let me draw this out first. This is pretty much what the market looks like at any given point. Okay. And the idea is that these Wyckoff price cycles are always made up of a combination of phase ones and phase twos. Okay, so let me write that in. So a phase one equals consolidation. Phase two equals trend or a movement. Okay. So let's have this in green and we'll have this in blue. Okay. So let me do that. Yes. So if we now go back through, we can see we have a phase one here. We have a phase one here. We have a phase one in here. Phase one, a phase one, and a phase one. Yeah, these are all the periods in that market where we have consolidated. If we then go to the blue, we can see after we've consolidated, we've come out into a trend. Each time. Guys, see that? So we have phase one is a consolidation. The phase two is the movement or the trend that has been created from the consolidation. Okay. Now, what's happening in the market at all times is we are constantly going through different schematics. So as the market is coming down, we see here, we've gone through number one, a reaccumulation. Number one again, a redistribution. But redistribution, where we go downtrend, consolidation, downtrend. So we've had a redistribution, a redistribution. We've come into an accumulation. Yeah, so we've come into the downtrend, consolidation, uptrend. From there, we've come into reaccumulation, reaccumulation, distribution. And the market is constantly delivering us with schematic trend, schematic trend, schematic trend. The reason why this happens is because when the market was down here, okay, the composite man knew that he wanted to bring the market to here. For whatever reason that might be, okay, the composite man knew, I want to make a big move higher, we'll take it to around about this point. But that move can never just happen in one straight line. What's essentially happened is we've accumulated down here. So we've executed lots of buy positions as the composite man to introduce enough buying pressure and introduce enough momentum in demand to cause the initial wave up to here. What's happened is that initial momentum we introduced lost steam. Okay. So now the composite man is like, damn, I need more fuel to make the next move happen. So I'm going to consolidate. I'm going to mislead the public. I'm going to accumulate more buy positions that will allow me to then take off again. Okay. We then re-entered another period of consolidation. We're misleading the public. We're re-accumulating more shares or more buy positions to make the next move happen. Patrick, I see you raise your hand.
Yeah, I have a question. So who actually instigates the consolidation? Is that effectively insider trading?
Not insider trading. It's just the central banks who are trading with so much money that they can. And to make that make sense, like if we were to look at elements. If we to look at balancing scales like this, okay, where one side is supply and one side is demand, okay? At any given point in the market, there's a certain amount of money on the sell side and a certain amount of money on the buy side for every millisecond or every tick in the market, okay? Like a millisecond in the market is known as a tick, like every tick, okay? And at any given tick, there is a certain amount of selling. There's a certain amount of money on the selling side and a certain amount of money on the buying side. So do you know how when we execute positions, we execute a position with a lot size?
Yeah.
Yeah. A lot size is just a reference to how many units you're buying. So a standard lot, so a 1.0 lot, is 100,000 units. So if you were selling one lot, so a sell position with one lot, you're adding 100,000 units to the sell side. Okay. And obviously, every millisecond in the market, people from across the world are executing positions in the market constantly. So for every single millisecond, there's constantly units on the sell side being introduced, units on the buy side being introduced, units on the sell side being removed as people close positions, because they're not just opening positions, they're closing positions, and vice versa. So there's always a balance between supply and demand, where when there's more units on the sell side, supply is heavier, supply takes control, which means the market moves down. If there is more demand in the market, or there's more units of buy positions in the market than there is sell, the market moves up. So the reason why the market's constantly moving up and down is because every single millisecond, let's say right on this millisecond, there is 250 million units of sells, but only 200 million units of buys. That would mean that the sell side is in control by 50 million units, which means the market will move down with a force of 50 million units. And that's our first candle, let's say, for that second. Let's say the next tick, there's now 300 million units of buy and 280 million units of sell. So the buy side is 20 million units in front, which now means we might move about half of that, yeah? Because that was 50 million down, 20 million up. Now let's say again, the next tick, there is 500 million units of buy, of buy positions and 200 million of sell. So the buy side is massively in control by 300. Well, now we have this massive move up because the buy side was much more in control. And every single tick in the market, we're constantly having moves up, moves down, moves up, move down. And that's what gives the market that typical movement. That make sense?
Yeah, no, that's perfect. Yeah. I was just asking, like, in terms of the actual like central bank, like you say, how do they influence that then? How do they influence the demand side?
Yeah, so I'm going to throw
I
that
take
in
it,
now.
is that the $1 million question? Or
no, I'm going to explain that now, actually. So I explain that as the lead up, and then this will answer it. So the reason how the central banks control this is because they are trading with like hundreds of billions, if not trillions of dollars. They have the ability to literally add so many units to either side of this that they want. They, like, let's say we had 200 mil here and 200 mil here. They could come in and just add 10 billion units because they have enough money to do that. Okay. So that's how they can make the market move quickly in one direction because they just heavily push into one side. If they want to consolidate, they do their best to balance the scales. So every kind of second and minute, like let's think of what consolidation is. It's this up and down and up and down and up and down. Here, as we go up, they'll push into the buy side. Once the market gets here, they remove from the buy side, they push into the sell side. From here, they remove from the sell side, they push into the buy side. So it's the way that they make the market move is they're constantly, every single second, putting money in and removing money from the market, because the simple execution or removal of a position will make the market move. Why? Because their positions are so large that the simple execution of that position or removal of that position tilts the supply and demand balance so heavily. In the same way that, let's say we saw a fish tank, yeah, and one person had to remove the water from the fish tank with a teaspoon, yeah, using a teaspoon to remove the water. And let's say you've got 100 people trying to remove the water, 1 teaspoon at a time. That's essentially what it's like for us retail traders. What the central banks do is they come along with a massive bucket, put that bucket in, take out half the water, and straight away they've caused such a big movement because they have the power to make such a big movement that what us retail traders were doing for 10 years doesn't even come close to what they can do in 1 second because of how much money they have at their disposal. So yeah, they're constantly just executing and removing buy and sell positions from the market to kind of push it to where they want. So when we're consolidating, they're constantly adding positions to both sides to bump it up and back down, so on and so forth. And then when they're ready to make the market trend, they then just heavily pump into one side. So that's why it's this idea of accumulating. Like this is a reaccumulation. They're accumulating as much buying units or as much buying pressure as possible. So when they then let it go, the market shoots. Go on, Gurpreet.
Yeah, you said that they do this thing among themselves, like they bump it and dump it among themselves. I've read this thing in one of the books in the early times that it's named after like wash trading, I think. That organization that buy and sell specific assets among themselves. And I just want to ask, isn't this illegal? Like at the end of the day, they are just manipulating the market among themselves to bring it up to the point.
No, it's not illegal. They control the markets. They control the markets.
In the wash trading section, it was specifically clear that it's illegal. So it can't be like a single organization. That's what I'm concerned about. Because
yeah, I mean, us kind of saying the composite man is a broad word that includes, because there's more than one central bank across the world. So it's not just one entity doing this. It's all the central banks, all the large hedge funds. Let's say if you just took the top 0.1% of entities that have the most money in the markets, it's them between them that do this. They don't coordinate it, but that's just how they make money.
I think I get what you're saying, like essentially just because of the volume of money that they've got, that determines the impact that they have on the market, which does make sense. It's interesting those terms, because I know them terms very well, accumulation and distribution, for investing purposes. So it looks like it's a similar concept. Accumulation is obviously growth, and distribution is the distribution of dividends. So for me, those terminologies are solid, and I can use that concept when looking at this and say, right, and identify the accumulation phase distribution phase, effectively.
Yeah, that's right. And I'm going to add a lot more to this as well. During this process then, where we're going through the consolidations, the trends, the consolidations, the trends, because we've just talked about how, and it was a great question that you guys asked to bring me into this now analogy of supply and demand and how we're constantly on this balancing scale. So because like we said, in periods of consolidation, the composite man or the institutions or whatever label people have for him out there, we'll just say the composite man for now, because he is constantly executing buy and sell orders in these periods of consolidations. What sometimes happens is if we just look at this reaccumulation in here for a second, in order to make this move, let me use a different colored pen so it's easy for you guys to see. Cool. In order for that down move to happen before we started the new uptrend, the composite man had to execute a position right at this level to push price down before executing lots of buy positions to push price up. Now, for some reason, I don't know the exact reason, but for some reason, this sell position gets left open. Okay, so a lot of the positions that were executed to push price down gets left open. So by the time we've come up to here, there's positions in this region that are still open and running in a loss. We call these unmitigated positions, what we call them. So this is what we know as a demand zone, because it is a region in the market where the composite man has left open sell positions that he opened back here to help him achieve the movement he wanted. Okay. So what does the composite man therefore then want to do at some point? Well, he wants to bring price back down into this region so that he can mitigate the sell position, which essentially just means take it out of the market before making the next move higher, so that he can get out of that position in a small win, a small loss, or a break even. Does he care if he's had a small loss? No, because he just profited loads from that. He doesn't mind. So we call this a demand zone because when price enters, not only are we removing supply, because we're removing sell positions, but we also accumulate. And when we accumulate, we're accumulating more buy positions. So we're removing supply and introducing demand, which is going to make the market go up. Okay. And that's how this idea of order blocks come into it. It's regions within which there's orders that need to be mitigated in the market. And that's why we kind of look into these regions to assume that price will want to come into it and reverse from it. Why does it want to reverse? Because the second we enter and remove those positions, we're instantly causing a change in the supply and demand balance. Sometimes we will even see in the market that price will, let me do this over here. Price will tap into these zones. It won't sustain a huge move up, but it will still sustain some kind of movement higher. And just because price taps into a zone doesn't guarantee us that that zone will sustain a huge move in our desired direction. It almost always reacts. Why does it almost always react? Because there is a physical shift in the supply and demand balance as soon as we enter this region and mitigate the sell positions that were opened here. However, when this does happen, it might not have introduced quite enough demand to cause a huge move higher. So therefore, the composite man is like, there was a bit of demand there, but not enough. We're going to come lower. Okay, so this is how we then tie in the idea of supply and demand zones. Why is this then important to understand? Because going back to this initial thing that I drew out, where I wonder if I can just get rid of all those extra. So coming back to this, which is exactly how the market looks at any given point. This is a typical move down and a typical move up. If we then look at Wyckoff's price cycles, we can see that this is exactly how he explains how the market moves. The 4 market phases is accumulations, uptrends, distributions, downtrends. Within our uptrends, we see reaccumulations. Within our downtrends, we see redistributions. But the idea is, because the markets happen fractally, we are undergoing a Wyckoff price cycle on all time frames. Okay. If we kind of then split that up into the 4 phases that Wyckoff talks about, this is our markdown. This is our downtrend. This is our accumulation. This is our uptrend, or our markup, and this is our distribution. So if we label that 1, 2, 3, and 4, which numbers do you think we want to trade in? 1, 2, 3, or 4? There's two of them we want to trade in.
3.
Yeah, 3. 3 and 1. Yeah, 1, 3. Yeah, well done, Capri. Yeah, 1 and 3. We always want to trade when the market is trending. Because when the market is trending, that's when the momentum is in the market. So what Wyckoff's price cycles actually help us to find in the market is it helps us to find the momentum. It helps us to read and predict when the movements are going to happen. I see you wrote something in the chat, Patrick. Let me check. What this then essentially means is that on a higher time frame, you have to understand, if we look at the daily or the weekly, which phase are we currently in on the higher time frame? Okay. For those of you guys who know me well, which market have I been trading the most recently?
Silver.
Yes, silver. Because if we look at silver and gold, yeah, and gold as well, Capri. When we look at silver, if I now zoom out to the 1 week, well, guess what phase of the Wyckoff price cycle we're in on silver? Well, let's label it. We've had distribution, we've had downtrend, we've had accumulation, and we're having now the uptrend. So we are in number 3. Okay. And I know that I want this market to come and hit this high. So I believe we will remain in the uptrend until $50 an ounce. And therefore we can assume that the market will continue in this fashion where we see move up, reaccumulation, move up, reaccumulation, move up, reaccumulation, so on and so forth, until eventually we've hit that $50 and then we will distribute. So why am I trading this so frantically is because as we then look at this, we've had the move up, remove borings, at the move up, okay, we've then had reaccumulation. We've then had a move up. We've then had reaccumulation. And we're now undergoing another move up. And there's still not any signs of us entering another reaccumulation. Okay, so we're moving up with a lot of speed right now, which means then as I come lower, I can look deeper into this. And this is again happening on all time frames, because even now on this time frame, we've seen move up, reaccumulation, move up, reaccumulation. And now again, we're currently within the move up. So the second this movement happened on the 22nd of August, where we broke out of the reaccumulation for like 6 days, that's the perfect condition to trade. Okay. If we then come down lower again, we can see since we did break out, which was this move here is where it started, we've seen the exact same thing where it's been move up, reaccumulation, move up. Why does it keep turning my brush off? Reaccumulation, move up, and we currently seem to be undergoing a reaccumulation. So if you guys remember correctly, the last position I entered on this market was in here. It's pretty much a position like this. Because I noticed that we were in a higher time frame reaccumulation. I noticed that we were getting ready to break out of that. I then noticed on the lower time frame, we were doing the same, where we just undergone this reaccumulation. How do I know when we're about to leave the reaccumulation? Because after we have manipulated the low, we want to see volume introduced, which is exactly what happened. I waited for the pullback. As we started to break away, I entered a position. I could have executed even more positions on top of that quite easily if I came down lower again and I saw we had move up, reaccumulation. The second we break out of it to the upside, you enter a position. After we have manipulated the low, we see momentum introduced. So I get involved in the momentum. So I can get involved in a position here. I don't even have to protect the low. If I can guess the momentum correctly, and I know when the momentum is taken off, I don't even have to protect the low, because I know there's too much momentum in the market for price to ever break the low. It's slightly risky, but it means I could be involved in a position like this. I would keep my take profit open. I would obviously apply safety measures, but I'd keep my take profit open. And I would look to just now ride this entire trend. Yeah. Same thing has happened here, but we've had another reaccumulation. We've entered this range. We've taken out the lows. When I see us break the high with momentum, we're in another position. And that's because I understand that we're undergoing phase 3, which is an overall uptrend on the higher time frames. Why have I been avoiding Euro US? Because if we look at Euro US on the higher time frames, this is what it looks like right now. This isn't a trending market to me. This is an undecided market. The market was trending for a little bit from February to July, but since the 1st of July, it's been sideways, and I'm avoiding trading that. However, with gold as of right now, and more prominently silver since April, we've been undergoing this trending market. Patrick, let me see. Are you able to check the example in trade ideas? And is this correct to what you're explaining? This is how you labeled it. So pretty close when it comes to marking out the accumulation. The accumulation would be go easy. Yeah, you're all good. You're all good. The accumulation would be this, because an accumulation is a downtrend, consolidation, uptrend. Yeah. So if we move back over to this stuff, an accumulation is downtrend, consolidation, uptrend. The blue boxes are representing the schematic in these examples. So this would be the accumulation. We would then enter the move up. We then have a reaccumulation because we've gone uptrend, consolidation, uptrend. We know that uptrend, consolidation, uptrend is reaccumulation. We've then gone higher again. What can be a little bit confusing here is that we've actually had a distribution into an accumulation, which I don't want to confuse things, but this in itself could just be seen as an overall reaccumulation. But it is technically a distribution into an immediate accumulation. So yeah, you got that one right. Yeah. We've then had a move up, another reaccumulation, move up, and then we are either going through a big reaccumulation or we're going through a distribution. It could be either. On the way the market's looking, my assumption is I want this to be a big reaccumulation and I want it to go up. But again, we've got to watch. What I have liked to see is that after the manipulation, we had a lot of momentum introduced. It's just seeing if this little movement inside of here can do the same, where we manipulate lows, momentum introduced. If I see it manipulate lows and I see momentum introduced here, that then confirms my bias that this is a reaccumulation and that we're getting ready for the next uptrend. So what I advise you all do is when you do a top-down analysis, make sure that one of the biggest things you can add to that top-down analysis is an understanding of where in this Wyckoff price cycle is the market currently in on the higher time frames. Okay, because you're always going to have a higher win rate in 1 and 3. Why? Because the market is trending, which means it's constantly protecting one side and breaking the other side. Why does that mean we win more? Because we typically put our stop losses at protected swings and our take profits at the previous highs in bullishness or previous lows in bearishness. When the market's trending, it follows those laws more strictly, where it will protect our lows and therefore hit our stop losses less, and it will break the highs and therefore achieve our take profits more. Okay. If we're in this phase on the higher time frame, so a 2 or a 4, price is constantly seeking out the highs and lows. It's seeking both sides, which means it's much more likely for your stop loss to be hit and much less likely for your take profit to be hit. So if we even just come down to statistics, you're just statistically more likely to win in phase 1 and 3. And where a lot of people go wrong is they almost get married to this idea that you have to trade one market or that you should be limited to a few markets. Never limit yourself to the market. Limit yourself to the condition of markets. So what you guys can probably see in my trading view is I now have pretty much everything. I have Forex pairs, commodities, indices, and stocks and crypto. And Mamonex has all of these. Yeah, I've lined them up. Mamonex, you can trade all of these on Mamonex. They have hundreds of things that you can trade, which is sick. All I do is I'm looking through all of these to see which of these markets are undergoing phase 1 or 3. Any that are undergoing phase 2 or 4, I'm sitting them out until they enter 1 or 3. But there will always be some markets that are undergoing 1 and 3. So you'll always find one, which for me was difficult at first because I used to think like I'm the Euro USD god. I only trade Euro. I'm going to master that market. And I fell into that trap where it's like, I'm only going to trade one thing. I'm going to become sick at it. Does it work for some people? You can make it work. But if you want to maximize your profitability, you have to diversify. So, for example, a couple of weeks ago when I did my analysis, I noticed that silver, what was the other market? Yeah, the US 100 as well. I noticed was going through this up movement, although it recently is showing signs of consolidating again now. So it's not as nice. And I was actually looking potentially at Netflix because we had this move up, we had a reaccumulation, we had another move up, and I thought we were getting ready to take the next impulse on the fact that we had the consolidation here, the manipulation, the move up with momentum. I thought this was a smaller time frame reaccumulation to take price higher. So I'm kind of watching it to see, now we've taken the low, do we now break out with high momentum? If so, I will look to buy it. Some of the cryptos at the moment aren't looking amazing, if I'm honest. So I'm kind of sitting these ones out. Up until like this point, Bitcoin was amazing. Up until start of August, because the exact same thing was happening where we were going through an uptrend from March to August. Perfect condition to trade. Same happened from September 24 to December 24. We went through that phase. During here, I'm sitting it out from December 24 to April 25. I'm not trading this market. During these, I am. So it's just keeping a kind of mental track. Gold right now is showing signs that we've just broken out of the overall reaccumulation. So this is now back on my list for buys. Because what I want to see is price following the same movement now, where we're going through the typical move up, reaccumulate, move up, reaccumulate. And it seems as if quite recently, we've gone sideways to reaccumulate and we've just broken out with relatively high momentum. So this could be, after the break, a valid setup where I'd keep my take profit open and ride it up. Go on, Patrick.
I have a question. When is a good time to exit a trade then?
So, yeah, good question. This then comes back into risk management. So how would I manage this trade? It's a really good question. So because I'm leaving a take profit open, never just leave it open and don't manage it. Okay, I need to kind of actually make that clear. I don't just leave it open and let it do its thing. What I do is I stop loss to break even. So probably now we've broken this high, I would have stop loss, move my stop loss to break even. Now as price starts to make its move higher, I trail my stop with it. So there's going to be a point in this move where we reaccumulate on this time frame and break out. The second we've done that, my stop loss now comes to this low or this low. And as we start to move up, I'm just smartly trailing my stop loss with the momentum so that I'm not limiting myself to saying, I'm just going to take a 3-to-1, because there is a small chance And there is a chance that price actually from now goes and runs 20 to 1. And why would I not want to let myself profit from it if it's going to do that? But as price kind of takes off from it, and we see these kind of movements happen, and it could move in anyway, but as we have these main structural points created, I will protect the lows of my stop loss. Or it might be a bit more aggressive. We might see it actually play out a little bit more like this. And I'm just going to protect the structure as we go, which means if price ever does break down, or AK gives me signs that we're no longer bullish, for example, we've broken that low, I'm out of the trade on the reversal. And obviously you can still use points of interest. Like, this is how you would get involved from reaccumulations, is you're essentially looking at the consolidation, ideally waiting for some form of manipulation. And once you've seen a manipulation, you're looking for that like injection of momentum in the market that's breaking out, which is exactly what we're seeing right now. And I wouldn't be surprised if for the next couple hours we have a huge move up. It might not, but I wouldn't be surprised because the momentum is now active. So even if we look down at the most recent consolidation we had, where we moved sideways, we manipulated the lows, we held at this region for a little while, but once we did break out, we did so with that much momentum that even if I went very aggressive on my entry, so where would I say the protected high is? I'd either be looking to get involved on this break or this break. Okay, let's say it's this break I get involved on. I can be quite aggressive with my stop loss placement. Doesn't have to be all the way down here. It could be on some lower time frame structure, because if I have accurately predicted the momentum, price should never come back down. If I tried to take that position in a market that was in 2 or 4, I would get stopped out. But if I take that position in a 1 or 3, because there's that much momentum, price should never come and blow my stop, which allows me to have a tighter stop, and it allows me to ride bigger moves, because that move alone would already be running in a 7 RR. Or maybe if we come lower, another prime example here, consolidation. We've liquidated the lows and we've seen that momentum. So we wait for that break, get involved in the position. Again, we could be safe and protect the low, or we could be aggressive and just protect that candle. In this position, if I just let it run, would now be 25 RR. How would I manage this? Once we've taken off a good amount, I'm making it a break-even trade. So stop loss to break even. Once I see some structural points are created like this, oh, can't go straight. My stop loss comes to this level. Once I see we take off again, my stop loss probably comes to this level. Once I saw us now start to reaccumulate here and we're up, I'm probably stop loss in this level. So I will be taken out if the trade starts to go against me, but on the off chance that we are undergoing, because this looks exactly like phase 3 that we've put in here, on the off chance that we're undergoing this phase 3 for another couple weeks to month or even couple days, I'm at least allowing myself to profit from the entire move. Let's say it went to this point. That's 38 RR. Does that, for people that are newer to Wyckoff, does that help you understand it more?